Every major economic crisis in the last century has minted more billionaires than it destroyed, not despite the chaos, because of it. In 2008, while 8.7 million Americans lost their jobs and $9.8 trillion in household wealth evaporated, a small group of investors didn't just survive, they made fortunes that would take generations to spend. John Paulson turned $15 billion in a single year, betting against the housing market. Warren Buffett deployed $26 billion into collapsing companies at fire sale prices. By 2012, those investments were worth 3 times what he paid. In 2020, the story repeated. While 22 million Americans filed for unemployment in a single month, US billionaire wealth increased by $1.3 trillion in the first 7 months of the pandemic alone. Jeff Bezos added $75 billion to his net worth. Elon Musk went from $24 billion to over $150 billion in 12 months. This isn't luck. This isn't timing. This is a pattern, a playbook that has operated in plain sight through every crash, every panic, every crisis for over 100 years, and the next crash will do exactly the same thing. Let me show you how it works. Here's what nobody explains about economic crises. They don't destroy wealth, they transfer it. When markets crash, assets don't disappear. Stocks still represent companies. Real estate still exists. Bonds still generate income. What changes is who owns them, and at what price they change hands. Every crisis follows the same sequence. Phase 1. Asset prices collapse. Fear takes over. Regular investors panic sell. Phase 2. Liquidity dries up. People who need cash to pay mortgages, cover margin calls, meet payroll, are forced to sell at any price. Phase 3. Those with cash and patience buy those assets at pennies on the dollar. Phase 4. Markets recover. They always do. And the people who bought at the bottom now own what the people who sold at the bottom used to own. This pattern has played out in 1907, 1929, 1987, 2000, 2008, and 2020. Every single time. The mechanics are documented. The winners are named in Forbes. The transfer is measurable. This isn't conspiracy. This is accounting. Let's look at some historical examples. First, the Great Depression, which took place between 1929 and 1932. When the stock market crashed in October 1929, most Americans watched their savings evaporate. By 1932, the Dow had fallen 89% from its peak. Unemployment hit 25%. Foreclosures displaced millions. Here's what most people did. They sold. Out of fear, out of necessity, out of margin calls they couldn't meet. They converted assets into cash at the worst possible moment. Here's what the wealthy did. They bought. Joseph Kennedy, yes, the patriarch of that Kennedy family, had exited the market before the crash. While others liquidated, Kennedy accumulated. By 1935, his net worth had increased from $4 million to over $180 million. Adjusted for inflation, that's roughly $4 billion today, built during the worst economic collapse in American history. J. Paul Getty did the same thing. While oil companies collapsed, Getty bought their stock at a fraction of book value. By 1957, he was the richest man in America. His famous advice? Buy when everyone else is selling, and hold until everyone else is buying. The mechanism wasn't complicated. It was access. Kennedy and Getty had cash when nobody else did. They had information. Kennedy famously said he knew the market was overheated when a shoeshine boy started giving him stock tips. And they had patience. They didn't need to sell. They could wait years for recovery. Regular people couldn't wait. They needed to eat. Another example is the financial crisis between 2008 and 2009. In September 2008, Lehman Brothers collapsed. The global financial system teeters on the edge of total failure. The S&P 500 would fall 57% from its peak. Home values would decline by a third nationally, and by half or more in cities like Las Vegas and Phoenix. Here's what most people did. They froze, or they sold. Retirement accounts that took decades to build were liquidated in panic. 401k balances dropped by an average of 31% in 2008 alone. Here's what the wealthy did. They went shopping. Warren Buffett invested $5 billion in Goldman Sachs in September 2008, not as a loan, but as preferred stock with a 10% dividend plus warrants. to buy more stock at $115 per share. When Goldman's stock recovered to over $200, those warrants alone were worth billions. He deployed another $3 billion into General Electric on similar terms, another $8 billion into various distressed companies over the following months. Buffett wasn't hiding this. He wrote an op-ed in the New York Times in October 2008 titled, "Buy American, I Am." But here's the critical detail nobody mentions. He wasn't buying the same things regular investors could buy. His deals included negotiated terms, guaranteed dividends, downside protection, and equity kickers that weren't available on any exchange. He was buying crisis insurance. Everyone else was buying lottery tickets. John Paulson's story is even starker. His hedge fund made $15 billion in 2007-2008 by betting against subprime mortgages, securities that banks were still selling to regular investors as safe. He saw the collapse coming because he did the analysis most investors couldn't access, examining the actual loans inside mortgage-backed securities and recognizing they were doomed. That's not luck. That's information asymmetry. And finally, we have the pandemic crash in 2020. March 2020, the fastest market crash in history. The Dow drops 37% in 33 days. 22 million Americans file for unemployment in 4 weeks. Here's what most people did. They panicked. Retail investors pulled $326 billion from equity funds in March and April. They sold at the bottom and sat in cash while the recovery happened. Here's what the wealthy did. They recognized the pattern. Bill Ackman's Pershing Square turned a $27 million hedge into $2.6 billion. That was in 3 weeks, by betting on a market crash in late February. Then he immediately pivoted, using those profits to buy stocks at the bottom. His fund returned 70% for the year, while the average retail investor was still sitting in cash. But the bigger story wasn't hedge fund managers, it was the structural advantage. During the 2020 crash, the Federal Reserve injected $3 trillion into financial markets. Where did that money go? Into asset prices. Stocks recovered, bonds recovered, real estate recovered, and then surged. If you owned assets, you got richer. If you didn't own assets, you watched from the sidelines as the price of entry climbed further away. Between March 2020 and March 2021, US billionaire wealth increased by $1.8 trillion. That's not a typo. $1.8 trillion in 12 months. Meanwhile, real wages for the bottom 50% of earners were flat. The mechanism was the same as every other crisis. Those with assets benefited from the recovery. Those without assets paid for it through inflation and higher prices for everything, from housing to healthcare to the stocks they'd eventually try to buy back at higher prices. Let me synthesize what the wealthy do, not as inspiration, but as documentation. First, they maintain liquidity. The rich don't put every dollar into investments. They keep significant cash reserves, credit lines, and liquid assets specifically to deploy during downturns. When everyone else is scrambling for cash, they are the cash. Second, they play longer time horizons. If you need your investments to pay rent in 6 months, you can't afford to hold through a 50% decline. If you're investing for decades, or for generations, a crash is just a buying opportunity. Third, they access different markets. During the 2008 crisis, regular investors could buy distressed stocks on public exchanges. Institutional investors could buy distressed debt, distressed real estate portfolios, and direct equity stakes in collapsing companies. These private markets offered better terms, better protection, and better returns. Fourth, they have information advantages. Not insider trading, though that happens too, but access to research, analysis, and expert networks that regular investors don't have. Paulson didn't use secret information to bet against subprime. He used expensive information, analysis that cost millions to produce and wasn't available on CNBC. Fifth, they're psychologically prepared. Wealthy families often pass down not just money, but mindset, the expectation that crises happen, the discipline to be greedy when others are fearful, the emotional training to see a crash as opportunity, not catastrophe. This playbook isn't secret. It's taught in business schools, written about in financial literature, and practiced openly by every major investor. But knowing the playbook and being able to run it are very different things. But why can't regular people do this? Well, here's the critical asymmetry. The crisis playbook requires resources that crises themselves destroy for regular people. You need liquidity to buy the dip. But crises are when regular people lose jobs, face unexpected expenses, and need to liquidate savings just to survive. The rich have cash reserves specifically for opportunities. Regular people have cash reserves for emergencies, and crises are the emergency. You need time horizon. But regular people are saving for retirement in 20 years, not building generational wealth over 50. A 50% crash when you're 60 isn't an opportunity. It's a catastrophe. You need access. Accredited investor requirements, $200,000 annual income or $1 million net worth, lock regular investors out of private markets entirely. The best crisis opportunities aren't available on Robinhood. You need information. Professional analysis costs money. Networks cost time and access. By the time something is on financial news, it's already priced in, and you need psychological preparation. But our entire financial education system teaches the opposite. Don't try to time the market, dollar cost average, stay the course, which is fine advice for normal times. During crashes, it means regular investors do exactly what benefits those positioned to exploit the crisis. This isn't a failure of individual willpower, it's a structural asymmetry built into the system itself. Let me be explicit about what this pattern actually represents. Every crisis is a wealth transfer event. Assets move from people who can't afford to hold them to people who can, from those who need liquidity to those who provide it, from the leveraged to the liquid. The scale is staggering. Between 2007 and 2010, approximately $16 trillion in household wealth was destroyed in the United States, but destroyed is misleading. That wealth didn't vanish, it changed hands. Foreclosed homes were bought by private equity firms at 40 cents on the dollar. Distressed stocks were accumulated by institutional investors. Collapsed companies were acquired by larger competitors. By 2015, the private equity firm Blackstone had become the largest owner of single-family rental homes in America, purchased almost entirely from foreclosure auctions during the crisis. Regular families lost their homes. Blackstone gained an asset portfolio worth tens of billions. Is this intentional? Not in the conspiratorial sense. No one planned the 2008 crisis to transfer wealth, but the structures that enable the transfer, those are very much designed. Tax advantages for long-term capital gains, accredited investor rules that lock out regular people, a Federal Reserve that backstops asset prices but not wages. The result is the same whether it's intentional or emergent. Every crisis accelerates wealth concentration. So what about the next crisis? Will there be one? When will it happen? Here's what the pattern tells us about what's coming. Economic crises are inevitable. Debt cycles, asset bubbles, and financial system fragilities guarantee periodic collapses. The question isn't whether another crisis will happen, it's when. And the wealthy are already positioning. Right now, cash allocations among ultra-high net worth investors are at elevated levels. Family offices are increasing allocations to private credit and distressed debt funds, instruments specifically designed to profit from companies in crisis. Institutional investors are raising dry powder for opportunity purchases. They're watching the same indicators: corporate debt levels, commercial real estate stress, consumer credit deterioration. They're not predicting the timing, no one can, but they're ensuring they have the liquidity, the access, and the instruments to act when it happens. Regular investors, meanwhile, are doing what they always do: fully invested, minimal cash reserves, hoping it doesn't happen on their timeline. When the next crash comes, and it will come, the same pattern will play out: fear, liquidation, transfer, recovery, and the gap between those who own assets and those who don't will widen again. Okay, so now we know all of this, but what can you do? I'm not going to pretend you can replicate the billionaire crisis playbook. You probably can't. The structural advantages are too large, but you can stop being the person on the wrong side of the transfer. Understand that cash is a position. Keeping 10 to 20% of your portfolio in cash isn't missing out during bull markets. It's optionality for crises. The wealthy don't apologize for holding cash. Neither should you. Extend your time horizon. If you're investing money you might need in 5 years, you're not investing. You're speculating. True crisis resilience requires capital you won't touch for decades. Stop consuming financial news during crashes. The news is designed to generate fear. That's what gets clicks. Fear is what makes you sell at the bottom. The wealthy aren't watching CNBC during panics. They're executing plans made years in advance. Build income resilience. The biggest vulnerability in a crisis isn't your portfolio. It's losing your job while your portfolio is down. Multiple income streams, emergency funds, and marketable skills are better protection than any investment strategy. And most importantly, recognize the pattern. When the next crisis comes, and you'll know it by the fear, the liquidation, the panic, remember that what looks like destruction is actually transfer. The question is which side of the transfer you're on. If this showed you the mechanism that operates in every crash, subscribe. Because this pattern isn't taught in schools, it's not explained on financial news. Understanding how wealth actually moves during crises is the first step to not being on the wrong side of it. The pattern has played out in 1929, in 1987, in 2000, in 2008, in 2020. It will play out again. The wealth doesn't disappear during crises, it just changes hands. Now you see whose hands it flows into.